Good afternoon. I hope everybody is well for this Tuesday afternoon. My name is Samantha Hanson. I am the National Manager here at Pepper Money for Sales and Broker Support. And I'm joined by Quinton Urquhart, who is our Credit Operations Manager. Today we're coming to you with an educational session all focused on home loans in the residential space for income and servicing. And then we've got Quinton running through a live payslip analysis for us. And in my opinion, it's probably one of the most complex PAYG payslips that I've seen in quite a while. So it's exciting that we're going to get under the hood, understand and analyse all of the different types of income that are built into this payslip, and then get Quinton to run us through how he's calculated the income. And just to understand and define what are those different types of incomes are that are on that payslip as well. So I'll throw over to you, Quinton. If you want to give everybody a bit of an intro on yourself, that would be great.
Sure, thanks, Sam. Yeah, as Sam said, my name's Quinton Urquhart, Credit Operations Manager here at Pepper. I've been on board for almost 8 months now. Prior to that, my experience is wide and varied to a degree. I've been involved in non-bank lending for probably 15 to 20 years, right across a breadth of risk, business development and leading credit teams. But I've also had exposure to balance sheet lending through the majors, particularly at National Australia Bank.
Beautiful. Excellent. And so what are you loving coming over to non-bank? What's probably your favourite thing, Quinton?
I think the fact that probably no day is identical. Every day is different. Every scenario is different. And I think particularly in the non-bank space, you certainly become a lot more in tune to people's personal situations and how you can actually help them progress in life from what I've seen so far.
Beautiful. Excellent. Very similar to my transition from major bank over to non-bank. Excellent. Okay. So just highlighting here the difference between, again, just that correlates perfectly to what we were just talking about. So bank versus non-bank. So what I love about Pepper is the options on us being so diverse and being able to cater for every type of client, really. So as you can see here with major bank, you're looking at, your typical client profiles, clean credit, strong credit scores and standard income, where with us, you can see that cascading credit model really does allow for full doc and alt doc options, business use cash out, people that might have adverse credit, 40-year loan terms, government income, late payments and debt consolidation, with really quick SLAs and a very experienced credit team that look at a holistic approach to understanding a client's scenario and being able to provide a solution. So this slide really excites me because, I've been at Pepper for just under 6 years, and coming to Pepper from major bank, when I first started as a BDM, we only had really the prime, near prime and specialist products, full and alt doc. And now we've built that out across a prime and a near prime offering for commercial and also SMSF loans. And we've also got a rock solid personal loan product as well. If you're not yet registered, we do have a personal loan webinar coming up on the 29th of this month as well, which will give you all of the insights into our personal loan product, just to assist you in diversifying your income streams that little bit more with Pepper Money. So we're going to touch on different income types, the percentage, how we utilise them, how we calculate them, policies that surround those incomes, and also serviceability. But it's amazing to see that since June 2020, there's been an increase in 31% with people having multiple jobs. So it just goes to show that, people are obviously needing support in being able to utilise all of those different income types. And that's what we do really well. So a real life approach, Pepper is definitely the poster non-bank for real life approach. In terms of our assessment, we do have, as mentioned, a holistic approach to assessment and understand your client holistically and the story behind the client to make sure that we can provide a yes rather than a no. In terms of your security and LVR, we have category 1 to 4 your category 4 is a LVR of 70%, and then your cat 1's LVRs all the way up to 95% for purchases. That's both owner-occ and investment purchases as well. And in terms of security in the residential space, we look at residential rural and resi, and we can also look at vacant land as well. In terms of income, we're going to run through that quite extensively today in this session. Serviceability, we'll touch on that as well. We've got a 2% and a 1% serviceability buffer, and I'll talk you through how that works in a few slides' time. Loan purposes. So we have in the residential space, we can do lending for personal purposes, but also business use as well. And in terms of business use, we can look at unlimited debt consolidation for business purpose cash out, which is unlimited as well. We can consolidate private debts, solicitor debts. So there really is a lot of options for your self-employed clients as well. And then credit history. We have a cascading credit model that really allows us to assist clients at any phase of a credit event. So we have our prime product, and I might just go back a few slides just so you can see that cascading credit model. You can see in the Pepper Money non-bank section here under prime, we can consider defaults up to $500 paid, non-financial defaults in that space. And then moving down to that near prime clear product, we can accept unlimited ones for non-mortgage arrears. So that might be credit cards, overdrafts, car loans. So anything that's non-mortgage related, we can accept unlimited ones. Now, what that means in terms of the client's repayment history information, when we look at a comprehensive credit report, we look at the last 24 months, but we only consider the last 3 months in terms of our assessment when it comes to non-mortgage arrears. And then we look at the last 6 months for mortgage arrears with major banks and 12 months for mortgage arrears with non-banks. Now, in that near prime clear product, as mentioned, we can accept unlimited ones for non-mortgage arrears. We can also accept unlimited defaults up to $1,000, whether they're paid or unpaid in that product as well. Now, we also assist with tax debt, but I'll touch on that in a few slides' time. In terms of near prime, we can assist with discharge from bankruptcy from 1 day. We can assist with Part 9 and 10 debt agreements. We can assist with defaults that are up to $3,000, whether they're paid or unpaid, an unlimited amount. If they're over $3,000, they do need to be registered for 2 years. The reason we look at 2 years in terms of the near prime product is because we see the client having been through a life event just after 2 years, which means they're on a prime trajectory. So the next stop for them would be to move up to that prime product or out to another lender. In terms of mortgage arrears, we will consider that in the Specialist and Specialist Plus products. And we accept defaults that are over $3,000, that are less than 24 months old as well in that space. So the specialist product really is for clients who have just been through a major life event or who are going through a life event. In terms of bringing a client to us that may need a specialist solution, that's not the end of the road for us. We absolutely like to create a pathway for your client to not stay in that specialist product, but to assist them with their immediate need and then work with them to transition them up that scale. So up to the near prime product or up to that prime product so that they know where they need to go and then they know that there's some light at the end of the tunnel. But I just wanted to highlight that cascading credit model. It's a little bit easier when you've got that visual in front of you. Now, in terms of income, so we can assist clients across all of our products. There is tenure requirements that are required for different products, but across the products, we do accept newly employed clients. We can accept them from just 1 day employed, casual job or second job or casual income, overtime and bonuses, car allowances. We can accept 100% of your car allowances, 100% of your overtime and bonuses. Casual and second jobs, we can accept 100% of income there. and as mentioned, newly employed. We can do from 1 day employed for permanent, part-time or full-time clients. Quinton, I might just throw to you in terms of the newly employed, second job or casual. Are there any allowances? Is there any room to mitigate policy for these income types in terms of exceptions?
Yes, there is. To answer your question, there's probably one that happened recently, and it's probably a very, very good example where under a prime product, they neither met the 12 months continuous employment nor the minimum 6 months employment. However, they had recently graduated from 4 years of university and actually then commenced a role within their particular field. So in that particular situation, that's probably a very, very good example of where we would look at an exception based on the fact that they've committed 4 years of their life to their specialty, their craft, for want of a better word, and that would be looked on reasonably favourably.
Beautiful. That's a great example of an exception there. Thank you. In terms of overtime and bonuses, just throw another question to you there, Quinton.
Sure.
So for example, you've got somebody who has changed employers recently, but you can see in their history that they've had consistency in overtime and bonuses. They've moved to a new role. They're not meeting that initial time frame that we're looking for, the 6 months or the 12 months for overtime.
Yep.
Are there any allowances again in terms of mitigating policy in that respect?
Yes, there is up to certain percentages. So, for example, if they've joined a new employer and we can see they may have been there for 6 months, we can potentially look at using 50% of the overtime that they have earned. And it also may come down to the fact that the particular trade or the particular occupation or profession that they have, and would overtime be a permanent part of that particular person's employment package? So there are a couple of aspects that we look at in regard to that.
Yeah, perfect. I think a scenario that sort of went through to application that was successful in mitigating recently on that point, where we had a client who stayed in the same industry from the prior role to the new role. The client was able to provide a letter from their employer confirming that overtime was a requirement of their role, and we just asked for a tenure within employment of 3 months so that we could look at annualizing that year-to-date figure effectively and be able to get the right income.
Yep,
so
perfect.
In terms of income, for everybody out there, if you can see that the situation or the deal makes sense and you've got adequate mitigation to support an exception to our policy, absolutely bring it to us every time. I wouldn't say go and lodge the application immediately. You've got your BDMs, you've got your relationship managers there to support you with exceptions pre-lodgement. And probably to you, Quinton, just an easy question here. How many exceptions do you think we probably get per day?
Oh, gee whiz, it can be, if I had to pick a number, it can be 15, 20, can be in excess of that. Yeah, it all depends.
Yeah, so we operate very much within the grey. If the deal makes sense, we're absolutely happy to work with you. So don't not think of us if it doesn't suit policy and you've studied the product guide. If it makes sense, bring us a deal and we'll help you support it. Okay, so income further explained. So pension and benefits. So this is where we go above and beyond in terms of utilising other income sources as well. So as you can see, we've got housing allowance. We take 100% of housing allowance, allowance provided by the employer or government bodies. That's what a housing allowance is. Forms of guaranteed income, so inheritance or trust beneficiaries, we take 100% of that. Superannuation as well, 100%. Family or government payments. So Quinton, I know that we look at Centrelink pensions, family A and B, single parenting payment, child support. Can you give me an understanding in terms of policy on those income types?
Sure. On our prime suite of products, we're generally looking for the family, government A and B to be received for at least or the remainder of 5 years. So that generally means that the cutoff age, when we're looking at the age of the dependent, is 11 years of age on our prime products. If the child is, say, aged 13 or 14, for example, on our near prime and specialist products, we are looking for that payment still to be received but we're also looking for some commentary on how the loan will be continued to be serviced once that income potentially drops off within that 5-year period. So how are they going to be able to service it once that income disappears?
On that point, say for example, I think for myself, clear mitigation that I would think is satisfactory would be that if the income drops off, the dependent's also leaving the house at that time as well. So that sounds like a no-brainer in terms of a response that I would put. Does that sound?
Yeah, that's a fair comment.
Yeah, perfect. Okay, cool. Beautiful. So moving on to self-employed income. So in our residential offering, we cater to personal and also business. In our prime product, we cater to personal purposes. However, that does not stop you from being a company borrower or a trust borrower, as long as the purpose of the loan is not business related. So they're not getting cash out for business purposes. They're purely investing. Then we can still look at that in our prime product. If you've got a client who wants to purchase, if they want to purchase a property under a trading entity name, that would then fall outside of that product, outside of the prime product. Or say, for example, they're looking at doing business debt consolidation or business use cash out. They're looking to purchase some equipment. Then again, that would fall outside of that prime product. And it would fall into that near prime clear product, which is the next step down in that cascading credit model, with rates starting from 6.99%. So really competitive interest rates. In terms of directors' wages, they can absolutely be added back. We add back 100% of depreciation. We also add back interest and dividend income. And then we also exclude company liabilities. So Quinton, can you just talk us through the exclusion of company liabilities? When can we and when can we not exclude company liabilities?
Yeah, we can exclude company liabilities if that debt is within or evidenced within the financials that we hold. And obviously the idea behind that is that expense has already been expensed through the profit and loss statement before the net profit before tax figure has been arrived at. So as long as we can show that inside the financials that we've been given, we would exclude that company debt.
Perfect. Now, not only do we look at a full doc approach for self-employed income, but we obviously have our alt doc options across the entire cascading credit model as well. So from prime all the way through to specialist plus. You've got options for different ABN lengths. So the prime and the near prime clear and the near prime full doc all require that 24-month ABN and 12 months GST if the business is trading above the 75K GST threshold. But in the near prime alt doc product, we can consider for clear credit clients a 12-month ABN. Or if they're not clear credit, we do need the 24-month ABN. And then the specialist alt doc product, we can consider an ABN from just 6 months as well for clear credit clients. Now you've got 3 ways to support your client's income, and we only need one supporting document plus the client's self-employed income declaration when we're looking at alt doc. And the 3 supporting documents are the last 2 or 4 quarter BAS from the ATO BAS portal, or an accountant's letter, which is when you're looking at utilising the prior financial year's income. And then you've also got the business bank statements. So we could look at the last 6 or the last 12 months for those bank statements as well. The reason I say 4 quarter, you've got the option for 4 quarters BAS or 12 months business banking statements is if you've got a client who has seasonal or lumpy income, it gives a better, it shows a better flow in terms of income, so we can make sure we're capturing the entire income for the year. So you've got lots of ways to validate for self-employed income and to utilise self-employed income. And then in terms of our servicing buffers, so we have had a 1% servicing buffer, gosh, I don't know how long now. I would have to say it's been maybe 12 months. It feels like it's been that long. So we have a 2% serviceability buffer for every client. There is no credit scoring at Pepper whatsoever. We have that 2% serviceability buffer for every client. That's our default. But then we've got a 1% serviceability buffer. Now, the 1% serviceability buffer falls into our prime and near prime clear products for LVRs not exceeding 80%. And then you've got 3 different scenario types that you can utilize your 1% serviceability buffer for. Now, the first is any fixed rate loan. So you could have an owner-occupied purchase, or you can have an investment purchase, or whatever the situation is. If the loan is fixed and you're not exceeding 20K cash out, then we can provide you with the 1% serviceability buffer. Now, just on the fixed, obviously fixed is not really a trending niche at the moment in market, but we do have no buffer that's applied to our 2-year fixed option. So you can look at any rate on our rate card, lock it in for 2 years and fix it. And then there's no additional buffer added to that interest rate. It stays exactly the same as the rate on the rate card. Now, in terms of break costs, we don't charge breaking economic costs with our fixed loans. There's no break cost whatsoever. So if you decide that you needed to use a 1% serviceability buffer to ensure your client gets into that first home purchase because it leverages that borrowing capacity, then you can use that as long as they're not exceeding that 80%, as long as they fall into the prime or the near prime product. And you can lock it in for the 2 years, which, as mentioned, there's no additional buffer on that interest rate. And if they choose to break it in 6 or 12 months' time or whatever they want to do, they can do that over the phone within a couple of minutes, and there is literally no break costs. So there's no detriment to the client to fix it. The only the benefit that we're providing there is just that that bolstered up borrowing capacity to assist them there. In terms of refinances, we can look at providing the 1% serviceability for refinances. Again, the cash out is capped to 20K, so they can refinance the current loan, cash out up to 20K, but they can also include an unlimited amount of debt consolidation on top of that cash out of 20K. Now, as long as those debts have been managed effectively, so there's no late repayments and they fall into that prime or that near prime clear product, we can do an unlimited amount of debt consolidation. Keeping in mind, prime is personal purposes only, but that near prime clear product, you can consolidate business and personal. We've recently also updated our policy to reflect 40-year loan term is available on all of our products in the residential space as well. So again, utilising that 1% buffer in conjunction with the 40-year loan term can really assist with getting those clients that may be at that point where they've leveraged themselves too high in terms of accumulating a lot of little debts. They're about to come undone in terms of not being able to make those repayments. You could bring them over to us. You know, obviously we don't look favourably at short-term lending, but what we are looking favourably at is putting those clients into a better situation, tidying up those debts, putting them into a more manageable situation with an easy to manage 1 monthly repayment, and then setting them up for success, getting themselves back on track. And if they want to go back to a mainstream lender, absolutely, that's what we're here for. We wanted to provide solutions and assist those clients in managing their finances. The last option here is for investment purposes. So you can do the 1% serviceability buffer for investment purchases as well. So you've got 1% capped at that 80% LVR, 1% servicing buffer capped at that 80% LVR, and you can apply that 40-year loan term in that prime product as well. Now, the only caveat to the 40-year term is it must be P&I, can't be interest only. We also have some end ages when it comes to the client's age at the end of the loan term. Can you just talk me through that, Quinton? What do we deem acceptable as the end age for an owner-op purchase and an investment purchase?
There's a couple of ways you can look at it. Firstly, you're looking, or the first inquiry you're generally making is what age is the applicant looking to retire? And that's generally acceptable anywhere between 67 and 75 years of age. So then you're looking at potentially maybe a reduction in loan term. But as I said, that may not be the case depending on the person's asset position. You may be able to give them a 30-year loan term, on the basis that they have significant assets. So when they do decide to retire, the debt can be extinguished. I guess the best way to answer that is no two scenarios are ever the same. They're all different, and each and everyone's personal situation is different. They're all assessed on an individual basis, but in terms of loan terms, when we get to that stage in life, it all depends on the asset position would be the best way to answer that.
So from what I'm hearing from that, and to sort of tie in what I used to say to brokers, typically we'll take the end age of the applicant up to the age of 85 at the end of the loan term for owner-op purchases or refis, and up to 99 years of age for investments. And obviously that's not a given. We're not just going to give that to anybody.
Yes.
But it's being able to effectively pay out that debt at that time. So
correct. Yeah.
The client.
Yep. Yeah. There's just I mean, it's generally called in the industry like a sanity test, just on their situation. When are they looking to retire? If they do want an extended loan term, firstly, how do they intend to keep working? And then we get to that position, how do we at least ensure from an owner-occupied point of view that they can have their owner-occupied property clear and free, so that they can actually enjoy the rest of their lives.
Beautiful. Excellent. Okay. So I'm going to hand it over to you, Quinton, and you're going to take us through this crazy payslip.
Yes,
it looks quite complex.
Yep.
And I don't know, I must be a weirdo, but it makes me excited looking at this type of payslip, all these different income sources and types. And yeah, there's a lot in here. So I'll pass it over to you, and you just let me know when you want me to move on to the next slide.
No problem. Thanks, Sam. Yeah, look, as Sam said, we come across payslips that look like this across various different industries. This particular payslip came from, or it's actually a corrective services officer payslip, but you would see very similar payslips potentially across police, ambulance, anybody where there's essential service workers or even potentially tradespeople will have, probably not to the extent of this particular payslip, but will have certain allowances, certain overtime, certain sources of income, be it pre-tax or post-tax, that you can potentially look to use to increase the borrowing power of your customer. So if I focus particularly just on this payslip, when we do get one like this, there's a couple of things or a couple of aspects of this particular payslip that we are looking at. Now, I hope you can see it, but the first thing, if we look at this as a real live scenario, the first part of this payslip that really sticks out when I looked at this was, you can see that the applicant's total gross payments over on the right-hand side, or the top right-hand side, are 10,531. That's his total gross payments. You can also see at the bottom, right in the middle of the screen, there's some year-to-date figures there, which will indicate that the year-to-date figure is also 10,531.55. So that indicates that this is his applicant's first payslip. So if I approach this as how we would look at this in two different scenarios, being the fact that it is somebody that's just started in a particular role, and then secondly, we'll look at it the way for somebody potentially if they've been in their role for 6 months, then how would we look at the allowances? So the first part that we would look at, assuming that they have been in their role or they've just basically commenced, is we're really limited to using essentially what ordinary hours that they earn, and any incidental allowances or sick leave or the like that fall under normal hours paid. So you can see from this particular payslip, he has ordinary hours incidental, there's an incidental allowance, a sick leave, and hours paid but not worked, which I'm not sure how you get that, but I wouldn't mind it on my payslip if I could. So very simply for this particular one, on the basis that he's just commenced his job, the total of those 5 or 6 allowances there is a fortnightly gross income of 3,792, giving you an annualized gross income of 103,276. Now, if that obviously is sufficient to service the particular debt that you are looking for, based on the fact of his employment tenure, then that is the income that you would input into the servicing calculator. As you can see there, we're straight under gross annual income of 103,276. If, for example, the second way we would approach this payslip on the basis that we would have a 6-month evidence of overtime allowances, etc., we could then look to firstly use the entire gross income amount there of 10,531, whilst at the same time reviewing a year-to-date figure to see the consistency of those allowances and the overtime that he's been earning for the past 6 months. So you can see the fortnightly income there that I alluded to at the start of 10,531 over 26 weeks, giving an annualized income of 273,819, which we would input into the calculator as per right there, 273,819 into gross annual income. Now, if we can move on to the next one, Sam, for me, please. Okay, there's a couple of other aspects that really stick out on this payslip, and these, as I mentioned, these are common across these types of occupations workers, also for what we term our essential services, as I mentioned, police, ambulance, etc. You will see a lot of these coming up on your payslip being salary packaging benefits, both pre and post-tax. Particularly emergency services workers are able to take certain portions of that as cash straight into their bank account. This particular example here, based on just from an experience point of view and the amounts that are being deducted both pre and post tax, tends to indicate that he may have possibly 1 or 2 car facilities that he is salary sacrificing. So there, in terms of maximising your serviceability, where these come into play, there is 2 ways that you can actually do this. You can actually, providing, as I said, that they have met the total employment tenure, you can look at using the entire gross income of 10,531, but also include the pre and post tax deduction as a total liability. That's one way you can do it. If serviceability works, then we proceed on that basis. Where serviceability may become somewhat of a challenge, we do have the ability to, firstly, with regards to the pre-tax deductions on a fortnightly basis, total those over an annual income and then deduct that from the total gross income of 273, which is roughly 252. You then can apply the difference of 22,000 odd as untaxed allowable income, and then just include the post-tax liabilities as liabilities.
Mm-hmm.
So I did a quick example, whilst they're not up on the screen today, just on an example that I mocked up on a $600,000 or $700,000 loan amount. The maximum borrowing capacity went from a figure of just over $1 million, whereby we used the total gross income and total debts, where it went to 1.4 million, whereby we'd used untaxed allowable income as well as just the post-tax liabilities. It was a difference of about $300,000 in servicing capacity.
Wow.
So, it's very, very, it's a very, very good aspect that we do offer. As we said, we will obviously offer these options, or the credit analysts in my team, if it's a straightforward assessment, they will just move straight forward with the assessment. But if there is ways to actually maximize the servicing that a customer or a broker is looking for, we will certainly then go down that path.
That is so refreshing to hear, Quinton, honestly, because, brokers don't know everything in terms of our policies. So I love that we take the approach. Again, as I said it earlier, we're not looking at ways to try and decline the deal. We're looking at ways to try and approve the deal. And if we can massage that servicing and applying policy, not obviously, doing something we shouldn't, but still working within confines of our policy to try and make the deal work, it's just music to my ears. It's so refreshing to hear that. Now,
Yeah, I was just going to say, Sam,
yeah,
and look, those types of industries, Qantas is another one. That's a big one as well. I'm sure people on the call have come across a Qantas payslip in their life, and they're not the most easy to decipher. Look, I just encourage you, if you're not exactly sure how to exactly decipher it, get your BDM involved. Generally, the credit team and the business development managers work hand in hand, and that difference at the front of the application process and making sure that we're maximising that income makes all the difference for a smooth assessment.
absolutely. I'll just quickly go back to the picture here of the serviceability calculator. And just to reiterate, the reason everything is in that gross annual income box is because we take 100% of all those allowances, the overtime. That's why it's all grouped into the one box. So there's always a lot of questions around why isn't there separate boxes? Why does it all go in the same box? And that's purely because we accept 100% of every income type, except for workers' compensation, which we look at taking 80%. So that's why there is only the one box. And then obviously you've got that untaxed allowable income box there. So that's the only time you would separate, obviously, the income there, is if you've got an untaxed portion. In terms of untaxed, while we're touching on that, say, for example, we've got a non-for-profit organisation, brokers are simply just separating the gross and the untaxed, and they're simply just putting them into the separate boxes. Is that correct?
Correct.
It's as straightforward as that. Yeah. Also, just pushing the boundaries a little bit with this particular pay slip. Say, for example, we had this client, so we obviously know that he's new to role, but assuming he's not new to industry, assume that he's got 3 years of tenure in this industry, and he's come over to this new employer. Could we look at, with a letter from the employer confirming that all of these allowances and the overtime is obviously a requirement of their role, could we look at, with that employment history that we've got confirmation on, could we look at annualizing all these year-to-dates on a 3-month basis rather than 6-month, and look at an exception to policy for this particular client in that scenario?
Yeah, look, you probably could if we say that he's been in the same industry and he's actually moved over, and the income levels at his previous roles are reasonably consistent with what would be annualized out on this particular one. He's obviously moving for better conditions, for better pay, etc. So we would certainly look at that. That's how we would look at it. He's got a history of earning that level of income, and he's certainly on track to earn it based on the payslip that we hold.
Perfect. Excellent. All right, so what I'm going to do, everybody, I'm going to run through this last scenario to finish off the session today. But before I do that, before people start jumping off, because I know we're creeping over that half an hour mark, and I know for you guys, I'm the same. Being engaged in anything longer than 30 minutes does my head in. So in terms of a promo that we've recently gone live with, it's been in market now for a couple of weeks. And it really does suit this educational series to a T. So we've got up to 90% no LMI for prime full doc loans. That's owner-occ and investment, no LMI, no risk fees, no lender protection fee, up to 90%. That's for both purchase and refi, full doc, up to 90% in that prime product. You can tie that in with a 40-year loan term as well, as long as you're looking at that P&I, and as long as there's a suitable exit strategy built into that. So if you're not aware and you haven't seen the promo or communication come out to you yet, 90% no LMI. It's not industry specific as well. It doesn't matter if they're Medico or not. It's anybody and everybody can utilize that. So it's a fantastic opportunity to obviously allow people to extract equity from investment properties and continue purchasing down that journey of purchasing another investment property, because they're obviously not going to get charged that LMI premium to take it up to 90%. If you want to know more about that, we do have a survey at the end of this session as well, where you can tick a box to say you want your BDM or your RM to make contact with you if you've got a scenario or you want further one-on-one training. So also, please, if you can just respond to those to the survey at the end of the session, that'll assist us in being able to support you better as well. So last thing, just going to take you through a scenario that I actually assisted with recently. This is a live scenario that we've converted or put into this presentation for you that just speaks volume in terms of the amount of borrowing capacity that we can assist with in comparison to a major bank. So this is Harish. He's a single dad looking to invest in property. He's got 2 kids, 8 and 15. His income that he has is $50,000 from his normal PAYG role, $15,000 in overtime, $10,000 in family tax A and B, plus $10,000 in child support. In terms of his expenses, we've run this through quickly as well, and the base HEM has come in at $2,800 for monthly living expenses. We've excluded rent because he lives with his parents, and we don't require you to put any notional rent into your serviceability if you've got somebody living at home or rent-free. And the client has good repayment history. So Harish went through a separation. He's moved back into his parents' house with his kids, living rent-free. He saved a little bit of money. He came away with a little bit of money from a separation as well. And he's looking to purchase an investment property for around $700,000. So with his salary combined with his family support benefit he receives, he had sufficient earnings to comfortably afford his mortgage repayments. However, as we know, major banks aren't accepting 100% of all of these different income sources that we do. So in terms of quickly as well, he was maxed out at a borrowing capacity with major banks at $543,000. For us, utilising the 1% serviceability buffer in conjunction with a 40-year loan term, 6% negative gearing add backs, the no notional rent, and 100% income for the family A and B and child support for the 8-year-old, we were able to offer that solution in the prime product for a massive $725,000. That's just huge in comparison to major bank. We haven't put in any non-banks into this equation as well, but we are absolutely number 1 on the ladder against our non-bank competitors as well. If you pop this solution through quickly, you'll see that we sit right up the top. Now, this is including your 40-year buffer and your 1% servicing, 40-year loan term and 1% servicing buffer. So this is capped at your 80%. If you were to go to 90% and utilize the no LMI promo that we've got in that prime full dot product for investment purchases, you would just have to apply the 2% serviceability buffer because the 1% is capped at that 80% LVR. So 2% servicing, but you've got all of those other additional servicing niches that you can include in there as well with your 40-year loan term, your 6% negative gearing and so forth. So if you haven't yet given us a go for borrowing capacity, I urge you, especially now with this no LMI promo, have a look into quickly, make sure you've added Pepper as a lender in your panel so you actually can filter and see the results, or speak to your BDM or RM today if you've got a scenario. Here's just a little snapshot of other lenders versus Pepper Money, just showing the incomes that have been utilised and that difference in borrowing capacity, which has all been taken from quickly. So that's it from us today. As mentioned, there's a survey that's going to pop up once I close out this webinar. So please do answer that for us because it'll allow us to service you better and provide you a great experience. And as mentioned, we do have the personal loan webinar that is going live on the 29th of this month as well. Just a really quick synopsis, $100,000 loan sizes, up to 7 years loan term, rates starting in the 6s, no fees whatsoever for the client, and there are definitely broker mandate fees that can be charged. SLA is only 2 hours for uncon and funding the next business day. It is such a great product. So join me on the 29th to learn more about that one. And until then, have a great afternoon and thanks for joining us. Thanks, Quinton.
Thank you.
See you guys.